curiosity gets the best of him. The poor college student gets over to and walks over to the quote unquote rich young man, and he says, "Hey, I hate to impose here, but it appears that you have a lot of money."
Yeah.
The young man says, "I do. I'm worth $1 million." He said, "Wow, how old are you?" He says, "I'm 18 years old." He says, "How did you get to be worth $1 million?" He goes, "I was fortunate. My dad died and left me $5 million." The point of it is the dad did not have a plan.
Yeah.
The kid was left $5 million, and a few months later, he's worth $1 million, right? Because those kind of things happen. Mm-hmm. So you have to have a plan. We've been doing this for 20 years and serving hundreds of families. We're going to bring solutions to your situation.
How do you choose a financial advisor? How do you know who you should
That's
work with?
the value of that 210 core, moving everything towards a purpose on purpose.
Well, hey, everybody. Welcome back to Your Retirement Blueprint Podcast, the podcast that is designed to empower you to create a life of financial confidence so that you can live your best life. My name's Kendall Stahl, alongside Mr. Phil Cooper.
Hey, everybody.
And we've got Mr. Jim Benckendorf back with us today.
Welcome, Jim.
We decided to take this a little deeper and get into a little more, I guess we'll say, estate planning or higher net worth kind of a topic for today's show. So if you didn't listen to Jim's last episode, he is a native of Morton, Illinois, went to college a long time ago at NIU.
They had colleges way back then?
Yeah.
Way back. Well,
then returned.
My boys, Stone Age, dinosaurs.
Stone Age. And then came back here, joined the family firm, took that over, Benckendorf Benckendorf, since '88, and specializing in complex real estate planning, tax matters, business information, and real estate transactions. So we're excited to have you back today to get a little deeper into what we kind of already started. I think kind of the goal was to talk about some higher level situations as much as we can without getting into the weeds too much. But basically, there's this estate tax thing out there that everybody hears about and sometimes get confused with, I think, and it really doesn't apply to everybody. Who's it apply to? State, federal, all those types of things. I don't know exactly the best place to start, but maybe we just start with where are those estate tax levels at, and what type of people are going to be.
Maybe even what is an estate tax.
Yeah,
Let's start with that, because I have a lot of folks that say, I've heard the estate tax was at this level. I have an IRA that's at this level, so I don't have to pay any tax on my IRA if I die. I'm like, there's two different animals right there. So maybe define what that even is.
Yeah, basically the estate tax is a completely separate tax, whether you refer to it as a death tax or what have you, wholly different than income tax. So that we all pay income tax and then we deal with it from that side. And likewise on an IRA, 401k, even if you draw it out, you pay tax on it. When your beneficiaries draw it out, they're going to pay tax
as well. Yeah.
The distinction is basically depending upon what your total net worth is when you pass away, depending upon what gifts you made as well during lifetime. If it exceeds the amounts either federal or Illinois, then there's an additional tax, the estate tax or inheritance tax is what some people refer to it as, that is due from there. And so,
okay, so let me ask a question about that, Jim. So the client has $1 million of investable dollars. Most of those dollars, if they're normal folks, that most of your dollars are going to be in what we call buckets of money that is yet to be taxed. That would be things like IRAs and 401ks, those kind of things. That's how most of us have accumulated our net worth, is through those kind of things. Some of us will have dollars that have already been taxed. But let's just say, and for this instance, I've got a $1 million bucket of money that's in a 401k or IRA. And yet I read the headline of a news one day, and it said that the estate tax was $4 million. So instantly, I concluded that my $1 million is less than $4 million.
Yeah.
And therefore, my children will not have to pay any tax on my IRA. That's not true. That's not true.
No.
Because what you're saying is the 401k/IRA is taxed at income tax levels, not at estate tax levels.
Well, it could be at both.
Okay, explain that to me then.
And so regardless, it will be taxed at as far as
income tax.
And so whomever pulls that out, they'll pay the income tax on it. And as you've addressed before, it's an issue where, basically current law, if it goes to a spouse, they continue the rollover. But if it goes to anyone else, then they've got 10 years to draw that out and pay the tax on it for the income tax. Whereas if that is part of your estate, and the $4 million is what the current Illinois exclusion amount is. So that basically, if you're below $4 million on that side in Illinois, then it's a scenario where you would not owe any additional.
So you're saying I would have my $1 million IRA in, and then I have to layer my house value, any land value, any life insurance value, and it just keeps on going. And if that number in Illinois gets above $4 million, I do have a different tax we have to deal with.
Correct.
It's additional. It's on top of.
Exactly.
Yeah.
Okay.
That's when you have the additional estate tax that you have to
All right.
So Illinois is $4 million. And is that per person or a married couple or what?
Per person.
Okay.
Yeah, it is per person. And right now that there basically is no what is referred to as portability in Illinois. So it's literally for Illinois, it's use it or lose it, unlike the federal, which you can port from one spouse over to the other.
Okay.
And so literally if the first spouse passes, and oftentimes they use the example, if a couple has $5 million of assets, first spouse passes away, they just transfer all of their assets over to the surviving spouse. They didn't use any of their exclusion at first, so now they threw away the first spouse's $4 million. So instead of having $8 million cumulative that they could pass down to the kids with no tax, now the surviving spouse has $5 million, $4 million tax. They owe tax on that extra million. Because if they don't plan and basically put the estate plan in place for that.
Yeah.
So what are the federal levels? 13 million or something for a couple?
For 2023, it was 12.92 million.
Okay.
And it's
Per
indexed.
person.
It's inflation indexed.
And it's indexed for 2024.
Okay.
And there is federal portability with that. So that then you have a situation where if each spouse, by example, has $5 million or whatever the amount is, so there's cumulative 10, all right, first spouse passes, they can deal with stuff. And if they do transfer it all down, they say, fine, they're here in Illinois, so they'll put it into what is referred to as, basically between a credit shelter trust, other things of this nature. It goes by A, B trust, marital deduction trust, variety of names. Bottom line is, we say in a family trust, then it's held there. They're using that $5 million, and for simple discussion, out of 13, they've got an extra $8 million. They can port that $8 million over to the surviving spouse. So the spouse that is surviving now has their own 13 plus the 8 that was unused.
So we have two entities we're dealing with. We got to deal with the federal level and we have to deal with the state level.
Correct.
So it takes a plan for both of those.
Exactly.
Okay.
It's a little harder to get to the federal level, though.
Well, depends if they have how well they've invested the money with you.
That's right.
So someone has an estate tax problem, so to speak, meaning they got more than $4 million in Illinois or 13 million or whatever it was for federal level. What are like first steps to start start dealing with that? I'm literally dealing with a client tomorrow. I think they're coming in inheriting money from a dad, and they don't think maybe they dealt with it real well. They had to write a pretty darn big check. The estate had to write a big check, I guess, to I think it was the state of Illinois. So I guess what are some of the first things that someone needs to be thinking about or putting in place or wherever you want to take it to start dealing with that issue?
One of the first steps usually is not only just looking at the assets and seeing what they are, but then addressing it. And what is common is putting in place, as I mentioned, what is I refer to as a marital deduction trust. So that way you're literally putting in trust so that when the first spouse passes away, their funds up to the $4 million, or depending upon if we're using, it's qualified terminal interest property, QTIP for an acronym, basically for an acronym, but basically so that we're setting that aside in this family trust, so that then instead of transferring to the surviving spouse, we hold that there. That counts as part of their federal exclusion. The assets remain there for the spouse's life usually. Okay. They get the income from it. If they spend their other assets, they can get the principal balance out of it. Okay. But bottom line is it's a way to actually use both of your exclusions from that side. And so it's putting a trust in place to go ahead and start to deal with that type of breakout of the assets.
So I'm going to say this back to you and you tell me if it's way off. And if it is, that's fine. So someone's got $5-6 million, over $4 million. They can, in a sense, give away whatever is over that to this family trust. They didn't really give it away. It's going to their family. In a way, we just use up part of one of the spouse's $4 million, essentially. And if they need to, they can get back to that money for whatever reason. Well,
normally it's set up so that you're actually transferring that into your own trust during your lifetime. Okay. So husband and wife would each have their own trust. They transfer their assets into those two respective trusts. And it's only when the first one dies that family trust is created.
Okay, that's what I missed. Okay.
So that's where that's going. And that you also, and we definitely deal with gifting and things of that nature. Yeah. So that we go ahead and we look at, all right, if you're over the exclusions, are there assets to where they do just want to or need to start gifting it down to family members? Likewise, that's when we start to structure things for charities so that we say, fine, are we going to use an IRA or 401k to start dealing with gifting, because it's better to gift pre-tax dollars.
Yeah.
Right.
Instead of down to the kids, you gift those to charities. And so we work through all of those things because that way the charity doesn't pay tax versus the kids.
And in that scenario that you just said, giving money from IRAs, 401ks, you're getting that out of your estate in your lifetime.
Mm-hmm.
And so it's therefore, hypothetically.
Yeah, either a life or a death.
Yeah. Okay.
So,
Yeah.
because I have a lot of clients that look at it and they have a charitable intent.
Mm-hmm.
And instead of putting it in the trust to say, all right, we're going to gift, a percentage of pre-tax as well as after-tax dollars to the charity, it's like, no, let's go directly with the qualified money, gift that to the charity, and leave basically the
big
money that
tax
gets
play,
a
yeah.
stepped-up basis
Yeah.
to the family.
Yeah. Right. You're really helping on taxes there.
Yeah. I often hear people say, well, I'm just going to give the money to my kids then. But that doesn't really work, right? Because there's caveats in there. If you give it all away, if you give a bunch of money to somebody, you got to claim it towards your estate deduction, right? Even when you're alive. Maybe
Correct.
Can you pair that out a little bit more?
Yeah.
I think you know what I'm trying to get at.
Yes. Yeah. Basically, and you're correct. People will say, fine, if they do just want to give it away, then they can
Yeah.
do so.
I'd rather give it to my kids than the IRS.
Yeah, exactly.
Yeah.
Thing is, they do have to file a 709 gift tax return if it exceeds, as far as the amount of gift to each person, basically if it exceeds the annual exclusion.
Mhm.
And basically for 2023, that exclusion was 17,000. It's going up to 24,000. Basically up in 2024, it's going up to 18,000 per person.
Okay.
And that is from an individual to any number of other individuals. And so it's a matter of basically, if you have 3 kids, all right, there's $18,000 that you can give to each one of the kids.
Per spouse.
Per spouse. Exactly. And so, using that scenario, husband and wife, 3 kids, there's $108,000
Yeah.
you can give to them with no reporting.
Yeah.
And so it's the de minimis amount in essence where the IRS says, just fine, take care of that. Once you exceed that, then you have to file a gift tax return. And that comes off your federal exclusion at the end, or Illinois exclusion.
So if you got your Illinois, just an example, exclusion of $4 million, and you give someone $500,000,
Mhm.
right? You have to put that on your taxes, and then now you no longer have $4 million. You have 350 or 3.5. Yeah.
Mhm.
Kendall, I think one of the greatest things that I have been able to do maybe in my career, and this is I speak to the hearts of the client for a moment, is I believe that one of the greatest things that we have done and continually will strive to do is to bring things down to a simple enough approach that it causes people to take action.
Mm-hmm.
Because if we start talking about high complex things, if you're a person like Phil Cooper,
Yeah.
I turn off a switch in my brain. I acknowledge you're speaking to me,
Mm-hmm.
and I'm not understanding a word you're saying. It's
Yeah.
not because it's an intelligence thing. I'm a simple person by nature. If you will say, Phil, take step 1 and don't do anything until you take step 1, then we're going to go to step 2. I'll follow you through that process.
Sure.
And so you might be very, very blessed financially in your life, and you've accumulated large amounts of dollars and assets, and the complexity of meeting with someone like Jim may be stopping you.
Yeah.
I want you to know that I have sat in meetings with Jim for 20 plus years. The simplistic approach that his firm takes makes you want to take action.
Mm-hmm.
Because again, if you're like me, you're like, I'm done. I can't follow through this because Jim is a very educated person and he has great ideas, but he has, what I'm taking away from already in this podcast was a plan. You got to have a plan if you're going to get anywhere. Number 2, it's got to be simplistic enough that he just says, take step 1 and let's not worry about step 2 till step 1 is taken.
Mm-hmm.
If you take enough steps, and there's that old proverb that says a journey of 1,000 miles begins with 1 step.
Yeah.
You take that 1 step, we'll get you to step number 2, then get you to step number 3. Pretty soon you look back and go, we accomplished great things by taking 1 step at a time. Let's not try to eat this whole elephant.
Sure.
Let's take a bite out of this thing and say, let's get this simple enough where you take action.
Yeah. Absolutely.
Yeah. And that's why, to be honest, with a lot of it in the planning, it's really an issue where what I try and deal with is to say, fine, let's figure out where we are. Let's look at the total assets. Let's look at the family. Let's look at the situation of who you want things to go to, who you want to take care of it.
Yeah.
Then, okay, when you pass, where do you want to be? And so what is the end goal? We figure out how to build the bridge.
Reverse engineer near that,
And we literally look at it to just say, you don't need to worry about the process for now. Let's just get these 2 points. we'll figure this out. And then we'll say, all right, now here's the steps to get there.
Absolutely.
Just like
You
you're saying,
bet.
Phil. And so, but it's the whole basically path that we have to walk.
But Jim, am I accurate in thinking that if they follow this simplistic approach and take action, we have to take action,
Yes.
that the outcome could be so much greater for them and their families versus some of the downside that could happen to them by not taking action. Would you agree with that?
Oh, very definitely.
Could you give us, and maybe I'm putting you on the spot here, can you give us an example of someone who did not take action? What can come out of that? I have an estate. I have some dollars. I have a house. I have some land. I have a car. I've got things that all of us have. And just by me saying I'll do it later and didn't do it, what's that look like later for my family?
There's a myriad of things that it looks like. And yes, coming to mind, one of which is people came in afterwards, didn't set up the plan for us, what have you, individual past assets went out, ended up certain assets went down to the grandkids through beneficiary designations. They were young.
Yeah.
And basically they received checks at 18.
Yeah.
And
The harm
by
that could be
19,
done.
the money
Yeah.
wasn't there.
Yeah.
And so here's a couple $100,000 from each one of them that's just gone within 6 months to a year. So that's one downside is suddenly it's a matter of, okay, yeah, the nice car, whatever else is suddenly acquired, but then lost.
Yeah.
Or other things. The money is just spent. You have other aspects wherein people don't deal with the planning and then suddenly something happens and you realize, okay, wait a minute. How much are we going to write in the form of a check? Just like you mentioned earlier, Kendall, on that side. And had there been planning that had been done in advance,
What was the difference?
then
Yeah.
you got that set. And then you look at the opposite end of it to go ahead and say, all right, here we're talking about the wealth side of it. You look at it from the other extreme to go ahead and say, all right, for Medicaid aspects, individuals that end up in a nursing facility.
Yeah, right.
And so there, had they been able to deal with the planning and take care of it, then they could have tried to go ahead and salvage some of the funds, not for the idea, and I always say I'm not doing any of that type of planning for the benefit of the kids. It's the idea of, no, we try and hold these funds back because you earned them, let's deal with it so that you're not limited to this very small amount of state benefits.
Yeah.
Let's try and deal with other things so that if you need something, okay, there's going to be some funds there. And so absent that planning, it doesn't happen and the money is just exhausted.
Okay. I have a story, Jim, that encapsulates this.
Okay.
You're going to appreciate it.
Can't wait.
Yeah. Kendall's like, oh boy, where's this going? Right.
Phil's got another story.
This is good. So this young man's sitting in a fast food restaurant, right? He barely has 2 nickels to rub together. He's a college student studying for a test, sitting there eating his cheeseburger.
Yep.
And he looks out the window of the fast food restaurant and a brand new bright red Ferrari pulls through. And boy, the 18-year-old kid catches his eye, right?
Pretty sweet.
Wow. He watches this car drive around. The car comes around and parks. A young man gets out of that car who's the same age as this college kid. And he's thinking, oh my gosh, the kid getting out of the Ferrari is dressed to the nines. I mean, he's looking good and he's driving a brand new Ferrari. And this kid, this college student, man, his interest is piqued. He's like, what in the world's going on here? So he watches the guy go up, orders food, comes, sits down by him. Curiosity gets the best of him. The poor college student gets over and walks over to the quote unquote rich young man and he says, hey, I hate to impose here, but it appears that you have a lot of money.
Yeah.
The young man says, I do. I'm worth $1 million. He said, wow, how old are you? He says, I'm 18 years old. He says, how did you get to be worth $1 million? He goes, I was fortunate. My dad died and left me $5 million. The point of it is the dad did not have a plan.
Yeah.
The kid was left $5 million and a few months later he's worth $1 million, right? Because those kind of things happen. So you have to have a plan.
Gotcha. So I don't know if you want to go into some of the long-term care stuff or not.
Yeah, I think that'd be a great segue there, Kendall, because here's what happens a lot of times after doing what we do for as long as we've done it. I hear this more than I care to. It's a myth, Jim, that's out there. I hear a lot from my clients. They say, I know I need to get a trust because I don't want to give all my money to a nursing home.
Mm-hmm.
Can you dispel that myth?
Well, yeah, people think that they basically, if they create a trust, put the assets into the trust, they can still have access to those assets and those are protected. They go to the nursing home, Medicaid will cover it.
Yeah.
Basically, that's what is referred to as a first party trust. If you put assets in, you can take them back out. It's for yourself, first party.
You have access, yeah.
Medicaid, the nursing home looks at that the same way. You could take them out.
It's your money.
You're going to pull them back out for yourself and pay the nursing home. And so it does not protect it from that side. Other people will look at it and say, okay, if I make it an irrevocable trust, then I have limited aspect and rights. Okay, in some respects, you can do that. There's one provision where, all right, I can transfer assets into a trust for my spouse. The spouse gets the income, not the principal. Principal's held in trust, goes on, and this gets a little more detailed than where you're probably going.
Yeah.
And so there's certain carve-outs on that. But the idea of there's this wonderful thing called the 5-year look-back rule. And basically from the time, on any application that you go ahead and make for any type of nursing home or with Medicaid, basically on that side, there's a variety of questions on that within the last 60 months, have you made any transfers for less than fair market value, i.e. a gift in any way? People say, well, yeah, I sold the house for $1,000. It's like, no, that's still a gift. It's worth $100,000. That's where it's not, okay, did you just give it away? And so it's the idea of if it's less than fair market value. If you've done that within 5 years of filing for Medicaid, then you're going to trigger basically the provisions within the Medicaid rules that say, nope, we're going to exempt you out of that. And then we get into a whole nother spend down provision that we have to go through. So
that's a state of Illinois specific look back rule. It's not a federal rule.
Well, it is federal, and then those are adopted by the states.
By the states, okay.
Yeah.
All right.
And Illinois was the last state in the country to go ahead and adopt the rules. And they made them more punitive than most states. So,
which means what?
Basically, we have a longer penalty provision in the way that the calculation would work out.
Okay.
To be very simplistic.
Yeah. Okay. All right.
So,
who are, I guess everybody's situation is probably different, but are there certain folks that are better candidates for that type of planning than others?
Yes. Basically, if it's something that if you have enough assets or income where you can self-insure, then you really don't have to worry about it from that side. Because if you have the income to go ahead and cover it, or you have the majority of the income set through whether it is, pension, Social Security, guaranteed income source, to where, all right, if you end up where, you may have a shortfall of $1,000 a month,
you can self-insure that.
Self-insure.
So is there, it's kind of like the folks that have enough money to self-insure don't really need to do it. And it's almost like the folks that need to do it maybe don't have enough. I mean, because it sounds like you got to give up control and only get the income more or less if we're making it real simple, right?
Correct. In many respects, or give it up completely.
Yeah. And then, so those people hardly probably have enough money to do that. Is that?
And this is it. And that's why normally it ends up, and because the Medicaid guidelines are basically, there's spousal empowerment rules and things of this nature. So the community spouse one's still in the house if it's husband and wife. Then basically it's a scenario where in that case, the community spouse is still allowed the house, car, prepaid funeral, and $109,560 of assets and then income set aside. And so with those provisions, all right, if you're at $300,000 of other assets, then all right, do you look at doing planning? Probably.
Okay.
But if it's an issue where, all right, I just put my husband into the nursing home, probably not. You may be too late now. And so not necessarily, because there's different things as far as Medicaid annuities. There's all sorts of
There's a lot of options. Yeah. Right. Yeah.
All the way up to the end.
Yeah.
But it's just to get the fullest extent of the planning. Yeah. You got to start that earlier. And you're exactly right. If you're at basically below the $110,000 threshold of other assets, then all right, it's questionable. Do you deal with it or not?
Yeah.
And so it's just all a matter of looking at the numbers and the health perspective as well as the potential longevity of the individual.
Yeah.
I hate to put it that way, but
no, it's true
reality,
too.
That's what it is. Yeah. Okay.
Yeah.
Yeah. I've always struggled with that one personally. Like it's hard to ever really know what the right answer is.
Yeah, I know. Here's what we tell people all the time. If you went to a long-term care facility, there's one thing I can guarantee you. You're alive.
Yeah.
Otherwise you wouldn't be there, right? And if you're alive, generally what has not stopped? Your incomes.
Yeah.
Whatever your streams of income. If you're a Social Security recipient, your Social Security is still coming in. If you're a pension recipient, it's still coming in. If you have some kind of an annuity payment, it's still coming in.
Yeah.
So if you're alive and you're in the home, your sources of income can help alleviate some of the cost of that care. I've had folks that say, if I go to a home, I don't want to lose my home. If I go to a nursing home, I don't want to lose my home. But I look at their income, and it's well sufficient to care for them in the home. They're self-insured, in my opinion. So the point of the whole thing is we just make sure that you understand what you have and that there's a plan in place to mitigate against the risk on those things.
Yeah.
Right.
Yeah.
I think that covers quite a bit of what I wanted to get to. Is there anything that on your mind, Phil, that you wanted to get to today?
There is. When it comes to tax planning, Jim, and when dealing with estate stuff, I'm going to make an assumption, and this is the point. Kendall had said this to you earlier. If I say this wrong, correct me in this, please. Here's my assumption, that when we pass away, assets are most likely going to transfer to someone or something. Either when I say something, it could be a charitable organization that I have chosen, or it could be a church, it could be something like that. The something that I transfer dollars to, I think you said this on our first episode, the previous episode, and it caught my attention, and I think really needs to be expounded on, and that is if a person has money that has not yet been taxed, that would be like your IRAs, your 401ks, those kind of things. If it is your desire to leave some dollars to something, not an individual, but a non-for-profit organization, did I hear you correctly in saying those types of dollars, your IRA and your 401k, can leave your estate and go to that charitable organization? They can receive them tax-free, and your estate can give them tax-free?
Correct.
Then if it's also that person's desire to do some of that, and they've got a lot of other dollars that are already taxed, it'd be more efficient to leave those dollars to the somebody, the person, the children, the grandchildren, those kinds of things.
Yeah, and that's exactly it. Because with the IRA 401k, as mentioned earlier, that remains taxable money on that side. Whereas a portfolio account, basically a taxable portfolio account, real estate, farmland, business interest, whatever it may be, that's going to get a stepped up basis to the fair market value as of the date of death. And so as a result, you can eliminate all of that taxable gain on that side. That goes down to the kids. They only pay tax when they sell it, but only based on the difference from the date of death value to what they sell it for. And so instead of the entire asset being taxable going to the kids, you leave that pre-tax IRA to the charity portion of it, and then all the stepped up
huge
assets.
tax play.
I see that. I honestly see that quite a bit. People that will say, hey, we really want to leave some money to some sort of non-for-profit, right?
Yeah.
And then they got 3 kids or whatever. And they're like, well, we're just going to leave this bank account over here that's got 50 or 100 grand or whatever the number is, to the non-for-profit. And I'm like, whoa.
Yeah, let's reverse that maybe.
Let's reverse it. Let's have a little tax strategy here. Because there's definitely a lot of different levers that can be pulled.
I think we've come down to this conclusion every time we do a podcast like this, and it's this: you must have a plan.
Absolutely.
Wherever you're going, you got to have a plan. And not having a plan, by the way, it's a plan. That's a plan, and it might be a plan to write bigger checks to
the IRS,
Uncle Sam versus your children or something. You have a plan by not having a plan.
Exactly.
It all comes down to what do you want to have happen out here? Jim stated, this is where you are. This is what you want to have happen. Let's just build a road between the two and get you there. It's pretty simple.
Yeah, otherwise, you don't plan, you can pay for the road outside.
You will be
by paying the money to the state. So.
You are the new infinfrastructure bill.
Exactly.
Yes.
Seems like you're doing too good of a job because our roads got a lot of potholes.
Yes, they do.
We need to let some of the dollars flow to the infrastructure.
So if you want to know if Benckendorf is doing a good job, just check
what kind of road are you driving on?
State only not getting any money.
Jim's keeping all the money out of their hands.
Oh, that's good. Well, I think we kind of ended in the same spot, right? Like you said, have a plan.
Get a plan.
Here's kind of what happens if you don't. We talked about estate tax levels, and I brought up earlier, 6-figure checks that you can stroke pretty easily, and more than 7 figures, I'm sure, in a lot of cases. Make sure you have a plan. Understand what's going to happen. If you're on that type of a level, you definitely need to sit down with somebody and walk through some sort of estate or legacy planning, however you want to say it. So let's do this. Where can they find you guys at if they have questions?
I'm office in Peoria and Morton both. And then likewise, as far as online, Benckendorf.com, or just call phone numbers, Morton 309-266-6121, Peoria office 309-673-0797. And one of my partners or associates or I will gladly work with you on any of it.
I think really the point we're trying to make here today is, you potentially have a problem, whether it's Jim or somebody else. Let's go figure it out.
Absolutely. Make a plan. Get it done. You got it.
Well, I try to be the resolution, not the problem.
Yeah.
But, so.
Yeah. That's what I'm saying. If you have a problem, you need a resolution. Jim is the resolution. Sorry. All right. This week in history. Ready?
Fire away.
January 7th, the first U.S. commercial bank opened as the Bank of... I feel like this is something you would know just because you know random things. Do you know what the first bank was?
I'm going to say Bank of America, but I don't know this answer.
You're wrong. I would have guessed that too. The first Bank of North America in Philadelphia. Bank of North America.
And what year was this?
1782.
Wow,
a long time ago.
Wow.
Oh, here's a good one.
Alexander Hamilton.
Yeah.
First Secretary of Treasury, right?
I don't know.
It's like two sages and then teaching the young lad over here. Yeah.
History? What? I was supposed to know that.
And then you can look at, all right, and who was the first banker, basically, to set up this country on that side. So
Okay.
That'll be another
JP
podcast.
Morgan?
That's another show. That's another show.
Hey,
JP Morgan.
exactly it.
Yeah.
All right. Go ahead, Kendall.
Very good.
Was that Jamie or is that somebody else? No. Oh, that was JP himself.
Yeah.
1975, first Wheel of Fortune show premiered. There you go. My grandma used to watch that all the time.
Yeah, there's a generation didn't miss an episode of that.
Yeah.
Yeah.
Oh, man. Well, thanks for joining
Should
us
we sing
today,
the Wheel
Jim.
of Fortune song? Wheel!
You go ahead.
Fortune!
I don't know
Jim,
it.
thanks for being with us today. It was very, very valuable.
Happy to.
All right, guys. Well, we'll be back again with another episode of Your Retirement Blueprint podcast. As always, if you like this information and you want to get notified when we put more out there, just click those buttons and that'll happen for you. We'll see you next time.
Thank you, guys.